The average person does not buy a house. He buys an anchor, paints it the color of success, and then spends 30 years wondering why every important decision in his life feels heavy. I have watched people misunderstand debt for most of my adult life. They think the pain is the payment. They think the misery is the interest. They think the moment the mortgage is paid off. All that happens is one bill disappears. That is kindergarten arithmetic. The real story is harsher than that. A mortgage does not just pull cash out of your checking account. It drags on your career, your courage, your health, your marriage, your timing, and your ability to tell the truth about what kind of life you actually want. That is why two families with nearly the same income can live in two completely different psychological worlds. One family still wakes up on Sunday night and starts doing the math in the dark. Mortgage, cars, groceries, insurance, taxes, student loans, one more school expense, one more home repair, one more unexpected bill. They are not checking the numbers because the numbers change. They are checking the numbers because they are hoping the anchor somehow got lighter while they were asleep. It never does. The other family lives on the same street, drives something similarly ordinary, and does not look like royalty. But one morning the husband decides to take a week off. No emergency, no dramatic speech, no begging his manager. He simply does not go in. That difference is not personality. It is not luck. It is not even mainly income. It is weight. One family is still dragging the anchor, the other one cut the chain. If you want to understand what really changes after you pay off a house, you have to stop thinking like a homeowner and start thinking like a capital allocator. I have spent my life allocating capital. The first rule is simple. Anything that raises your monthly survival cost owns a piece of your mind. Anything that lowers your monthly survival cost buys a piece of your freedom back. That is the frame. Not romance, not pride, not homeownership mythology. Weight and freedom. Look at the math the way an owner should. The average monthly mortgage payment in 2025 sits around $2,329 if you use broad numbers for people who bought or refinanced at recent rates. Something like $2,845 is closer to the lived reality. Median American household take-home pay lands around $5,400 a month after taxes and payroll deductions. Do the arithmetic without sentimental language on a median take. Home income, a standard mortgage, can consume roughly 43% of disposable income before you buy a single bag of groceries, fill a single gas tank, pay a single phone bill, or solve a single problem. 43%. Most competent financial people agree that about 28% is a healthier threshold for housing. So millions of adults are not walking around with a slightly expensive house. They are walking around 15 percentage points over the line, month after month, year after year, while trying to convince themselves this is just adulthood. It is not adulthood. It is slow financial strangulation dressed up as normal life. I want you to feel that sentence because most people politely step around it. They do not want to admit how much of their so-called stability is actually one giant immovable payment swallowing oxygen. Imagine a couple earning $110,000 a year. On paper, that sounds respectable. It sounds like the sort of number that should solve most ordinary problems. Then real life gets hold of it. After taxes, payroll deductions, and a modest retirement contribution, maybe they bring home around $6,800 a month. The mortgage takes $2,400. Property taxes take about $380. Homeowners insurance takes $200. A maintenance reserve, if they are honest, should take another $320 because the furnace, the roof, and the plumbing do not care about anyone. Budget, that is roughly $3,300 gone just to legally remain inside the structure. Half their air is gone, and we have not even opened the rest of adult life. Now add 2-car payments because suburbia is usually a transportation tax with lawns attached. Add insurance, add gas, add student loans because modern society sells education with one hand and collects years of cash flow with the other. Add health premiums, add groceries, add utilities, add phones, add internet. Suddenly the month is almost dead before anybody has laughed, rested, invested, repaired, helped a parent, handled a copay, replaced shoes, or made one decision based on aspiration instead of obligation. That is what the anchor really is. The mortgage payment is not just an expense line. It is a silent filter sitting in front of every life decision. Can you leave the job you hate? Filter it through the anchor. Can you start the side business you have talked about for 4 years? Filter it through the anchor. Can one spouse take a lower paying role with more dignity, better health, or more meaning? Filter it through the anchor. Can you step back for 6 months to retrain, recover, regroup, or care for family? Filter it through the anchor. By the time people have done this for 10 or 12 years, they stop noticing the filter. They think they are cautious. They think they are practical. They think they simply prefer security. Number, they are towing steel and calling it personality. That is the first brutal truth. The house is not the whole burden. The burden is the way the payment colonizes the decision-making process. Now let me tell you what happens when the chain is cut, because this is where the personal finance world becomes childish. It tells you the nice version, you save your payment, you invest the difference, you feel relieved. That is all true. It is also wildly incomplete. When the mortgage disappears, you do not gain the full payment. A paid-off house is not a free house. Property taxes still exist, insurance still exists, maintenance still exists on a $400,000 home. The ongoing ownership cost can still be around $838 a month, sometimes more in high-tax states. So if the monthly mortgage was $2,845, what you really freed is closer to $2,000 of deployable monthly cash flow, not the whole $2,845. And $2,000 a month is not a minor detail. At 8% annual returns, that $2,000 a month becomes about $146,000 in 5 years. Around $365,000 in 10, roughly $693,000 in 15, about $1,177,000 in 20. You contributed $480,000 over those 20 years. The market contributed around $697,000 on top. More wealth came from time and compounding than from your labor itself. That is the part the lending machine never advertises. The bank sells you the dignity of ownership. It does not sell you the cost of delayed compounding. And let me push the knife a little deeper because this matters. Most people think of the mortgage as the price of the house. That is not how I think. I think of the mortgage as the price of postponing the phase of life where capital starts working harder than you do. The longer the anchor stays attached, the later you enter that phase. That delay is invisible while you are living it, and devastating when you finally calculate it. Now, I know the mathematically aggressive person is already forming his objection. He says if the mortgage rate is low enough, the superior move is often to invest excess money instead of prepaying principal. In a spreadsheet, that is often correct on something like a 3% mortgage. Historical stock market returns have frequently beaten the guaranteed savings from paying debt off early. There are studies showing that investing the excess outperformed accelerated payoff in the overwhelming majority of long historical windows. And yes, many existing mortgage holders still carry rates below 5%. But I have learned to distrust any spreadsheet that assumes the human being attached to it behaves like software. The spreadsheet assumes you actually invest the difference. Most people do not. They consume the difference, they upgrade the difference. They let the difference leak into vacations, restaurants, subscriptions, nicer cars, better furniture, and all the other little comfort purchases people call life improvement, when what they are really doing is preserving the anchor while decorating the chain. The spreadsheet also assumes that you can watch your portfolio fall 40% in a bad market while still owing a large mandatory mortgage payment and remain perfectly rational. That is fantasy for most households. There is a vast difference between watching investments fall when you own your shelter outright and watching them fall when the anchor is still attached to your throat every month. One condition is uncomfortable. The other condition produces panic decisions, marriages under stress, job submission, and emotional selling at exactly the wrong moment. And there is another point the spreadsheet does not know. Debt changes the brain that is making the decision. Researchers have found that eliminating debts materially reduces anxiety and improves cognitive performance. In one study, when debts were eliminated, the share of participants showing clinical anxiety symptoms dropped from 78 to 53%. That is not a cute self-help quote. That is a measurable change in mental state. People did not simply report feeling nicer. They became less impulsive. They became better at resisting short-term temptations that damage long-term outcomes, even more interesting. Closing debt accounts sometimes mattered more psychologically than the total dollar reduction itself. The brain hates open tabs. It hates unfinished obligations humming in the background. It hates recurring claims on future income. And the mortgage is usually the last giant tab. You must understand what that means. Many adults are making career decisions, family decisions, and investment decisions from a cognitively burdened state for years and calling it maturity. Then they use that compromised state to argue that holding the anchor longer is the more rational choice. Maybe, but do not ignore the possibility that the machine dragging behind you is also shaping the mind doing the calculation. I am not telling you to prepay at any price. I am telling you to stop pretending the calculation is purely mathematical. At rates above 7%, the case for aggressive payoff becomes far stronger. A guaranteed return in that neighborhood is not trivial, between around 4.5% and 7%. The right answer depends heavily on behavior, discipline, reserves, and your own psychology. Below about 4.5%, investing excess cash often wins mathematically. But only if you are the rare person who really will invest the difference. Keep doing it, and not let fear or lifestyle creep eat the plan alive. In other words, the answer is not just a rate. The answer is whether you are a person who can live with the anchor without letting it corrupt your behavior. That is a much rarer talent than people think. Now let me move to the part ordinary people miss completely. When you eliminate a mortgage, you do not just free cash flow, you lower your required life. That is one of the most powerful financial events on earth. In the arithmetic of financial independence, what matters is not only what you earn, what matters is what your life costs to keep breathing. If your mortgage costs you roughly $24,000 a year and then disappears, your annual mandatory spending can drop by that amount. Under a simple 25 times expenses framework, removing $24,000 from yearly survival costs reduces the capital required to support your life by roughly $600,000. Read that again. You did not get a raise, you did not start a unicorn company, you did not suddenly become smarter, you simply lowered the amount of life you are required to buy every year. And by doing that, you removed roughly $600,000 from the freedom number standing between you and independence. That is why paying off a house changes behavior so radically. It changes the floor. When your floor is high, you are obedient. When your floor falls, your options rise. That is not ideology. It is mechanism. A household whose survival requires 2 full incomes every single month cannot take intelligent risk. It can only pretend. It cannot pursue a meaningful pay cut. It cannot endure an uncertain launch period for a business. It cannot absorb 1 weak year. It cannot say no to a bad boss with the same confidence. It cannot easily move, retrain, recover, or renegotiate its life. Every plan runs into the same wall. Can we still cover the anchor once the mortgage is gone? The wall moves. And when the wall moves, people suddenly discover preferences they thought had died years ago. The wife takes the role with more purpose and slightly less pay because the difference no longer threatens the structure of the month. The husband launches the contracting business he talked about for a decade because one bad quarter no longer sounds like foreclosure in his head. Somebody finally says no to the promotion that pays more but eats the soul. Somebody else cuts back to care for a parent. Somebody starts working 4 days instead of 5. Somebody goes back to school at 56 because the numbers now allow curiosity to exist. This is what I mean when I say the mortgage is not just a bill. It is an invisible employment contract. People think they work for a company. Very often they work for a payment. I want to linger here because this is where the whole story becomes moral. A life is not only consumed by deprivation, it is also consumed by postponed permission. Most people do not feel overtly trapped. They feel delayed. They feel they will make the brave move later. They will take the meaningful role later. They will rest later. They will try something later. They will finally invest heavily later. The anchor teaches a person to think in later. And later is one of the most expensive words in the English language. By the time later arrives, the risk appetite is weaker, the body is older, the children are grown, the marriage has absorbed years of compliance, and the habit of asking permission from the payment is so ingrained that many people continue living cautiously even after the mortgage is dead. That is the second brutal truth. Some people pay off the debt but keep the obedience. Do not do that. When you cut the chain, you must also relearn how to walk. Now let us speak honestly about the paid-off house itself, because fantasy is the enemy of good planning. A paid-off house is not a heaven state. It still carries costs. Property taxes nationally are up sharply from a few years ago, around 27% since 2019 by some estimates. Home insurance has jumped hard as well, more than 50% since 2020. In many cases, maintenance does not care whether you owe a bank, roofs fail, water heaters die on holidays, trees fall at the worst possible moment. If you live in a high tax state, the monthly carrying cost of a paid-off home can still feel like rent to the government. That matters because false freedom is dangerous. If you think the mortgage disappearing creates $2,845 of pure investable cash, and the real number is closer to $2,000, the gap will eventually be filled by reality, usually on the worst possible week. The wise move is to plan for the real number, not the fantasy number. Freedom grows best when it is budgeted. Honestly, and still, even after you respect those ongoing costs, the conclusion remains staggering. The paid-off home is not zero cost. It is just radically lower drag. That lower drag compounds into lower anxiety, lower required income, lower dependence, lower career submission, and a lower capital target for independence. That is a lot of lower, and lower is what creates higher. Another thing people misunderstand is who actually reaches this state. Roughly 40% of owner-occupied homes in America are now mortgage-free. That sounds encouraging until you look at the age distribution. A large share of those owners are over 65. Fewer working-age owners get there. The average payoff age often lands somewhere around 58 to 63. First-time home buyer age has drifted upward toward the mid-30s, which means a plain 30-year schedule can carry right into retirement. At the same time, older Americans are increasingly dragging housing debt far later in life than earlier generations did. Mortgage debt among seniors has exploded over the last few decades. A third of homeowners over 80 carrying mortgages would have been a shocking number in another era. That is not random. It tells you something unpleasant about the modern American financial structure. We have normalized taking a giant anchor and towing it into the final act of life, then calling that normal because enough people are doing it. It is not normal. It is mass adaptation to a more expensive system. Only a minority of Americans are completely debt-free. That means the state we are discussing is not merely a financial milestone. It is a different operating environment. The people who get there often report the same thing: not ecstasy, not yachts, not fireworks, silence, a strange silence where a background hum used to be. That hum matters. Most people underestimate how much of their fatigue is cognitive noise from open obligations. I have noticed this in investing all my life. The best decisions are often made when noise is low. The best business judgments are often made by people with enough cushion that they do not need to take every bad deal that knocks. The best marriages are helped by the absence of recurring financial suffocation. The best health habits are easier when every month does not feel like a controlled collision. Noise reduction is not glamorous, but it is an enormous source of life quality. And paying off a mortgage is one of the most powerful noise reductions available to an ordinary household. Now let us be practical. If the finish line is so valuable, how do you move it closer without turning yourself into a martyr? Again, owners think in mechanism on a mortgage around $450,000 at 6.5%. The standard payment is about $2,844 a month, and total interest over 30 years can exceed $573,000. Think about that. The lender can collect more in interest than the original price of the property itself. Beautiful business. If you are the bank-heavy chain, if you are the borrower, there are boring methods that change the timeline materially. Biweekly payments effectively create the equivalent of an extra full payment each year. That alone can cut roughly 5 to 6 years off the loan and eliminate around $119,000 of interest. Add an extra $500 a month to principal, and you can shorten the timeline by about 8 years and kill roughly $150,000 of interest. Add an extra $1,000 a month and the term can collapse toward 17 years instead of 30. Those are not microscopic changes. They are life changes disguised as amortization details. The difference between paying off at 55 and paying off at 63 is not merely 8 years of reduced debt. It is 8 years of lower required income, 8 years of higher optionality, 8 years of earlier compounding on redirected cash, 8 years of a quieter nervous system, 8 years in which decisions can be made from strength instead of monthly submission. That is why I do not laugh at boring payoff tactics. Boring tactics produce loud life changes, but let me also warn you against a common stupidity. Do not become so obsessed with killing the mortgage that you starve the rest of your system. A household without liquidity is one emergency away from replacing one form of stress with another. Before you sprint at principal, look hard at your emergency reserves, retirement match, high-interest consumer debt, insurance gaps, and behavioral discipline. There is no trophy for becoming mortgage poor in the final miles. The goal is not symbolic victory. The goal is structural freedom. That means sequence matters. If the day comes when the last mortgage payment clears, do not immediately start behaving like a drunken king who just found a new room in the castle. First, confirm the boring legal details, make sure the lien release is filed, and the deed issue is actually clean. Adult life punishes people who celebrate before paperwork is real. Then rebuild liquidity. Most households that have dragged an anchor for years are thinner on reserves than they admit. Get 6 to 12 months of your new lower required expenses into liquid savings. Not the fantasy expense number, the real one after that. Root the freed cash with purpose. Take the employer retirement match first if it exists, because free money remains one of the few miracles finance still offers. Fill the Roth IRA if eligible, max the tax. Advantaged accounts that make sense. Use the health savings account if you have access to it. Then pour the remaining cash into low-cost, broad market exposure through a taxable brokerage account. You do not need cleverness here. Once the anchor is gone, consistency becomes terrifyingly effective. That is the part ordinary people miss. They think freedom creates chaos. It does not. Freedom creates room for a simple machine to work. For years, the mortgage was the machine. Your job was to feed it. Once it is gone, you can finally build your own machine and let it feed you. That is a profound reversal. Instead of paying interest first and hoping for leftover freedom later, you start buying freedom first and letting compounding build the rest. I want to say something uncomfortable to high earners now, because many of them are uniquely blind. They think their income protects them from the anchor. Often it only paints the anchor with nicer paint. A large salary can make a large mortgage feel manageable right up until it has shaped the entire architecture of your life. Bigger homes do not just create bigger payments. They create bigger required identities, harder jobs, longer commutes, more status maintenance, better schools, better cars to match the driveway. More social comparison, more silent pressure to keep the whole system looking consistent. Wealth is not what your house says about you. Wealth is the distance between what your life costs and what your capital can cover without begging labor for permission. That is why some modest paid-off households are freer than households earning 3 times as much. Freedom does not care what your neighbors think your countertops mean. Freedom cares whether you can survive a bad year without kneeling. And this is where the whole lesson returns to Buffett's world, because this is not just a housing discussion. It is the central capital allocation question of a life. What claims are fixed against your future, and how many of them can you remove? Every fixed claim is a chain: mortgage, car payments, student loans, recurring consumption habits disguised as necessities. The more fixed claims you carry, the fewer intelligent risks you can take, the more compliant you become. And the more every market downturn, Illness or employer problem feels existential. Most people think they need more upside. Very often what they need first is less drag. That is why I tell people not to romanticize leverage. Leverage feels intelligent when conditions are soft and options are many. It feels like a steel hand around your throat when uncertainty rises and your margin for error narrows. A mortgage is civilized leverage. It is also still leverage. Never forget that. And do not confuse endurance with victory. Surviving 30 years under the anchor is not the same as using your life well. Many people survive. Fewer cut weight in time to live differently while their health, nerve, and ambitions are still usable. That is the real heartbreak. The mortgage can turn into a sentence so ordinary that you stop noticing it. Then one day you look up and realize your most energetic decades were spent negotiating with one recurring obligation that is not always avoidable, but it should never be invisible. I want you to ask yourself a set of humiliating questions. If your mortgage disappeared tomorrow, would you stay in the same job? Would you keep the same schedule? Would you tolerate the same manager? Would you say yes to the same extra work? Would you postpone the same dream again? Would you keep the same city? Would you still need both incomes running this hard? If the honest answer is no, then stop pretending the mortgage is just a housing cost. It is an invisible hand shaping your life script. And if that invisible hand is this powerful, then the finish line deserves more respect than most people give it. I am not telling every person to throw every spare dollar at principal starting tomorrow. Life is rarely that simple. I am telling you to understand the event correctly. Paying off a house is not a cute milestone for a cake and a photograph. It is the removal of a major fixed claim on your future. It is the cutting of an anchor. It is the lowering of your required life. It is the quieting of background noise. It is the restoration of risk capacity. It is the moment compounding can finally breathe. It is the first time many adults can make decisions based on desire, values, and strategy instead of monthly survival math. That is a big thing, big enough that you should build toward it on purpose, not drift toward it accidentally. And there is one more mistake I do not want you to make. Do not assume that once the chain is cut, freedom automatically organizes itself. Many households lose the mortgage and then quickly invent a new anchor. Better vacations, more upgrades, lifestyle creep, new toys, new recurring obligations. The old bank chain disappears and the household forges a private one from consumption. That is stupidity in a more expensive suit. If the payment disappears and all you do is expand your appetites, then you did not free yourself. You merely changed who holds the chain. The point of cutting the anchor is not to drift into indulgence. It is to redirect the liberated cash into liquidity, ownership, and optionality until your life starts obeying you more than your bills. This is where discipline becomes noble. Before payoff, discipline helps you survive the anchor. After payoff, discipline ensures the absence of the anchor actually compounds into wealth instead of dissolving into nicer habits. Most people do not need a more motivational speech. They need a harder standard. Do not tell yourself you paid off the mortgage. Tell yourself you bought back a piece of your life. Then ask what you're going to do with it. Will you use the lower floor to build capital faster? Will you use it to reclaim time? Will you use it to take one intelligent risk while you still have the energy to enjoy the upside? Will you use it to quiet your nervous system and stop making decisions under chronic financial compression? Will you use it to create a family culture where the next generation sees ownership as optionality, not as a bigger and prettier cage? Or will you do what most people do, which is get temporary relief? Then gradually build the next expensive structure that requires your obedience. That is the choice, not whether you like your home, not whether home ownership is emotionally satisfying, not whether the spreadsheet can produce a prettier return in one scenario or another. The real choice is whether your life will continue to be organized around fixed claims, or whether you will deliberately reduce those claims until you can finally act like an owner of your time instead of a servant to your overhead. I like houses, I like businesses, I like productive assets, I dislike chains. And the older I get, the more I believe this, the happiest wealthy people are usually not the ones with the fanciest lives. They are the ones with the fewest compulsory payments attached to those lives. Remove compulsion and intelligence improves, courage improves, health improves, timing improves, relationships improve, investment behavior improves, not because magic entered the room, but because drag left it. That is the overlooked miracle of the paid-off house, not the bragging right, not the dinner conversation, not the little certificate of completion. The miracle is that the anchor is gone, and for the first time in years, maybe decades, the future is not being pulled backward every month by the same heavy chain. You can feel the boat move differently when that happens. You can turn faster. You can take weather better. You can choose direction rather than merely endure drift. And if you are still years away, good, then you still have time to treat the finish line like the strategic event. It really is. Run the numbers honestly. Respect the trade-offs honestly. Know your rate, know your habits, know whether you are truly investing the difference or just reciting that phrase because it makes you feel sophisticated. Know how much your required life would fall if the anchor disappeared. Know how many years you could remove with one extra payment, with biweekly payments, with $500 more a month, with $1,000 more a month. Know what job choice, health choice, family choice, or entrepreneurial move becomes possible once the floor falls. And then stop talking about the mortgage as if it were just another bill. It is not. It is one of the largest strategic forces in your adult life. So here is the test I want to leave you with. Picture yourself years from now, older, tired, still competent, but aware that your best decisions can no longer be postponed forever. In one version of that future, you are still lying in bed on Sunday night running the math, still towing the anchor, still translating every dream into one question. Can we cover the payment? In the other version, the chain is gone, the payment is dead, the floor is lower, the noise is quieter. Your capital finally has room to work. Your calendar belongs more to you than to the lender. Your decisions are being made from strength instead of monthly fear. Both futures are expensive. One costs extra principle, extra discipline, maybe some temporary sacrifice. The other costs years of obedience, delayed compounding, reduced courage, and a life organized around a weight you got used to calling normal. Choose carefully. Most people are not ruined by one dramatic financial mistake. They are worn into submission by a heavy thing they stop questioning. A mortgage can become that thing. Pay it off intelligently. Pay it off honestly. Or invest around it with absolute discipline if your rate and your behavior truly justify it, but do not sleepwalk beside it. Do not let the anchor define your career, your health, your marriage, your risk tolerance, and your last good decade without at least forcing yourself to look directly at the chain. Because after that final payment, the biggest change is not that a bill disappears. The biggest change is that you discover how much of your life was being dragged by something you once mistook for security.